Hi, this is Pete Andresen. This is September 17th, 2021. It's a Friday. I'm working on running 20 miles a week, so I'm a little bit on the tired side today, which is good. It means I'm getting it done. Sometimes the capacity to intelligently endure hardship is a good thing. Anyway, I wanted to talk today about what's going on out there because something has changed. And let's see if I can manipulate this thing. Share screen. Here we go. Boom. Okay. Thanks for bearing with me. I'm not that technologically proficient, and these are just updates for my clients. I want you to understand that I'm watching what's going on out there. I have a lot of opinions about it, and I want to share that with you so you'll know when you see changes in your portfolio, what's going on. Basically, I'm seeing some storm clouds out there, and I want to get into that a little bit. I want to show you what's concerning me as of September 17th, 2021, and let you decide whether or not you want to talk to me. Call me. There's the phone number, 831-758-1575. Now, I am told that I should put a disclaimer here. So this video is information for my treasured clients. I value you deeply. If you aren't my client, I'm not your investment advisor. So don't take this as strong suggestions to do anything. You'll note that I'm not putting any actual trades into this. Nobody has a crystal ball. These are my opinions based on 35 years of doing this and a lot of research. But they're still just opinions, and you never know what's going to happen. Financial markets can go up, but they also can go down. They can go way down. They can, the most nasty one I ever experienced was down about 65% in the tech markets. Maybe energy got worse last year. Anyway, my opinions in no way guarantee investment success. Actions that you are not seeing in these videos do a lot more to make financial success. But like I just said with my running, a big aspect is the capacity to defer gratification, to have the courage to act, to reverse what everybody else is doing so that you're buying low and selling high, not the opposite. Here are the storm clouds I'm seeing. And they're possible. Life can change on a dime. So it could be that we're not going to experience these. I want to review COVID briefly. COVID's the big story for 2021. It's gigantic, and people don't realize because we're just used to it. We're habituated to it, but it's big. I want to go over market fundamentals. I want to go over the coming debt ceiling issues, tax law changes that are rolling around out there, the political turmoil that seems to be just consuming us. Today, I heard that a drone strike carried out by the United States government killed 10 innocent people in Afghanistan the day after the Kabul bombings. So it feels like we're all coming apart, doesn't it? And finally, I want to just touch on inflation because I know somebody's going to bring it up. Let's start with COVID. It's right now we're in a pandemic of the unvaccinated. If you're vaccinated, the odds of you getting hospitalized or killed by COVID are very low. As you can see, I'll use my little cursor here. There you go. The unvaccinated had a terrible surge late in right here around April, May, June. And I think the reason somebody pointed out, I think correctly, that the reason this happened in the southern states was that it was their summer in the sense, or excuse me, it was their winter in the sense that summer in the South is when everybody goes indoors and crowds together. So this was their winter, whereas in the Northeast in 2020, the casualties were big because people got together and crowded because it was cold outside. And now we're seeing another spike. that's pretty much, as you can see, that's the unvaccinated. The vaccinated people are just trucking around. Yes, you can still get hospitalized. You can still be killed by COVID if you are vaccinated. But the big story here is that the vaccines are an astonishing miracle. But somebody's going to call me up and say, well, that's just manufactured data. That's fake data. So let's look at excess deaths from all causes. What they do is they take an average over the last 5 years. That's this black line here. And they average it out to show us what the average deaths have been for the past 5 years. This is 2015 through 2019. And you'll notice it goes up in winter when we have the cold and flu season. So that's the average number of deaths in the United States. Here's 2020, which blew the doors off. Again, spike, big spike. 650,000 excess deaths so far from COVID. Now we go over to 2021, and that's this purple line. It carries on right at December 31st. Here's January. That declines as the weather gets warmer and vaccines kick in. And now look at this. On the most part, we're almost back to the average number of deaths. Yeah, excess deaths. We're slightly above. But again, this is a pandemic of the unvaccinated. The untold story here is the tremendous American capitalist, marvelous development of those vaccines. Unemployment, which spiked, appears, it spiked. This was 2008. So this is the 2008. And these are permanent job losses. In other words, technology, the jobs get computerized away. Now we hit COVID, bam. Unemployment over a long-term duration of 27 weeks spiked. Now it's coming down. It's starting to turn. So the economic effects of the pandemic are also starting to turn. Of course, a variant could throw all of what we're saying right on its face. But essentially, we're probably, from what I'm hearing, looking at having an annual COVID/flu shot, and the unvaccinated will eventually get COVID, inevitably, and either get serious COVID or not serious COVID. One way or the other, things are turning. We're still in the middle of it. We're not done, but it's a triumph of these vaccines. So as an investment advisor, what I'm seeing is that this thing's not going to be a big issue in 5 years. What this says is it's still a transient event. It might take all the way to the end of 2021 into 2022, but eventually this will pass. And the question floating in my head, this is fascinating. We've got an issue. We've got a big issue in the United States. And it does relate to the issue of Afghanistan, and it does relate to the question of the last 20 years and Black Lives Matter and the riots and the January 6th Capitol riot, all those different things, all that hate. You turn on Facebook and all the hate comes pouring through, all the disinformation on both sides. I've watched perfectly decent people become absolutely nasty on social media, mocking the people who don't want to get a vaccine, not mocking the people who do get a vaccine, mocking the people who wear masks. What is that? I mean, who cares? Wear a mask. I don't care. I wear a mask. I mean, I'm happy to do that. The point is that we've become very uncivil, and there's a reason behind it. And that is that the United States is changing, and we don't necessarily know why. So here we have the Great Depression, this blue line, and that there was some government intervention, nothing in the like we've seen recently. But over time, the economy recovered and moved on. We, in the 2008 financial panic, on the red line, pulled out all the stops. Nothing that could be done was left undone. We did everything, government intervention at a cosmic level, and we end up in the same place as essentially the 1929 recovery without nearly as much governmental intervention. So the GDP, gross domestic product per person, grew less in 2007 to 2019 than in 1929 to 1940. We've actually had a slower recovery than we did from the Great Depression. Something is going on, and I'll get into that later. While we're looking at all this, I just want to put this here. This is an example of how we can miscalculate what's going on. So this is a picture tracking the bullet holes on Allied airplanes that encountered Nazi anti-aircraft fire in World War II and returned. So the airplane lands, everyone runs out and sees where they got shot, and this is where the bullet holes were. So the military says, let's reinforce these areas because that's where we've got the damage. But this Hungarian-born Jewish mathematician, Abraham Wald, pointed out that, look, the parts here, the engines, the front of the cockpit, and the tail, those are the places where you get hit and you don't come back. So sometimes it's the dog that doesn't bark. Sometimes it's what you don't see that becomes a big issue. And I'll be going into that shortly. Now, right now in the stock market remains overvalued by most measures. The stock market is measured by what? It's measured by indexes. We make indexes. So here's a Wilshire 5000. Again, the percentage of any individual stock that occupies that index is based on its market cap, how big it is. So here in 2000, we're starting in 1972. Here in 2000, it becomes overvalued, and what happens? That's the tech bubble, a big correction. Climbs back up a little bit, crunch, and then the bargain time happens. That was one of the possibly, I hope, in a way, I hope not, because I want more bargains in my life. And in a way, I do hope I never see that kind of crash again. 2008, and it's built back up until it's now, relative to gross domestic product, that's the American economy, more overvalued than it's ever been, at least as far as this graph shows. But here's the dog that isn't barking. These are overvaluations in market favorites. And as you can see, the weight of the top 10 stocks in the Standard & Poor's 500, you look at those, not the same time period, but close. You can see that the top 10 stocks becomes a larger percentage of the S&P in 2000. Then now it's dominated by, and you can tell me, the tech giants. And we all own some. But the S&P 500 is now basically 30% made up of the top 10 stocks. So it's not the S&P 500, it's basically the S&P 25, 30, 50. This is the PE ratio. That's a measure of valuation. Again, here's everybody else down here at 29.6 times earnings, which is overvalued, but not catastrophically. Then you got the top 10 at 29.5, which is dramatically overvalued. So this is a skewed market right now. Earnings contributions of the top 10 of the S&P 500, the spike in those top 10 stocks, they're contributing 34% of earnings to the S&P 500. Why? COVID and the giant adoption of technology. So we're in the midst of a technological revolution. It's been going on for a couple of decades at least, perhaps the entire time I've been in business. And what has happened as these essential monopolies emerge, like Amazon and Facebook and Google, they're oligopolies at least, they are obviously getting the vast amount of earnings in this new tech era, especially during the COVID shutdown. But we have a very, very skewed market. This is a slide from 2 years ago. It's from 2019, because I wanted to get it uninfluenced by COVID and uninfluenced by the chip shortage we've been experiencing. So Tesla has a PE, that's a price earnings ratio, that's a valuation of 395. In my entire career, I have never, ever, ever seen a stock hit 395 on a PE and not go down. I don't mean it'll die, but I've never seen a stock like that succeed in staying there. Either, which I've never seen, hypothetically, profit's going to rise up or it's going to go down. So we'll see what goes on. Ford PE is 16. That's another auto manufacturer. Oh yeah, Ford. Now, GM and Ford are laden with excess pension requirements. Just cancel those things and be done with them and move to a 401k. But they've got all kinds of health care, retiree issues. Back in the old days when they used to give people a pension like government does now, a defined benefit pension, the big corporations made major requirements that are now destroying them. Anyway, you've got General Motors and Ford making millions and millions of cars. Tesla's making 200, 300,000 cars a year. And yet Tesla's worth more than Ford and General Motors combined. And the reason for that is stock market mania. That's one of the keys that we're in a bubble. Just saw another stock come out, Dutch Brothers Coffee. The thing just spiked on the opening, which is classic bubble behavior. And now it's calming down. But that kind of stock market volatility, look at cryptocurrencies, is very indicative of a mania. Now, the other thing about this that's interesting, another dog that isn't barking, is that while we've got grotesque overvaluation in some stocks, other equity markets internationally, for example, remain relatively undervalued. Some of that is demographic, some of that is appropriate because they aren't seeing the growth. But right now, international stocks are trading at the largest ever discount ever discount to US stocks in terms of valuations. So bargain city out there right now. Why am I not buying? First of all, I already own some of that. You already own some of that if you're my client. So we're in it. Why aren't we into it more? And the answer is that I've done that before and watched the S&P 500 keep outperforming for years. I've lost clients over this. In the end, I'm vindicated, right? In 10 years, 12 years, 15 years, it works great. But getting there is tough to do when this thing can take decades to unwind. Also, all the Federal Reserve has to do is sneeze slightly and the stock markets will go up. The other feature here, remember I was talking about, one of the big storm clouds out there is debt, but I don't necessarily know what it means. Debt always means that you're deferring the cost of what you're doing today into the future. If you spend it on real, genuine education, as opposed to racial studies or something, if you spend it on economically productive education, like the GI Bill in World War II, it turns out great. If you spend it on genuine, essential infrastructure, not fake infrastructure, but real infrastructure, 21st century infrastructure that would have to do with our new tech economy, not Stone Age infrastructure, it's going to produce more in the future and the economy will grow and it will be good that we have taken on that debt. But meanwhile, we have grown the debt since the debt crisis of 2008 by 210%. We are absolutely piling debt upon debt. What does that mean? Potentially, it's quite dangerous because at some point we have to pay it all back. Maybe we don't. Maybe we just keep kicking that can down the road. But the implication is you end up with Japan, which for the last 30 years has been a stagnant, sideways economy. One way the government's doing this is to buy back its own debt. What's that? Well, it's not showing there, but basically about 30% of all bonds get bought by the government itself. So that's interesting. Wonder why that slide did that. Anyway, about 30% of the government bonds are bought by the government. And so it's a little odd. We could never do that. I could never borrow money from myself to pay off a debt, but the government can, because the government don't die, theoretically. If it ever does, if we ever do have regime change of some substantive amount, it's going to be a big deal. We remain at, I've pointed this out in past videos, but we remain in a low interest rate environment with 5,000-year-old low interest rates. We are actually at rates of interest below those quoted by the Sumerians, the ancient Greeks, the Egyptians, medieval Europe. I mean, we are stunningly in a low interest rate environment. And to look at how big that is at the beginning of 2008, as you can see, we had 4% interest rates on the 10-year treasury. So we've come from 4% to basically 1.5 in that time. And that's stunning how big a change we've had, even during that relatively short time in terms of history. The other thing is that this creates a bit of a trap, because if you've got that much debt out there, and corporations, as I've said, private corporations and municipalities and states have piled on this thing. So the debt load out there is gigantic. They've piled on, and now we have this situation where if the interest rate goes up, let's say it goes back up to 4, just back up to where it was in 2008, the refinancing cost would drive us quickly into a recession. So the Federal Reserve, not wanting us to go into a recession, is attempting to deal with that by keeping the interest rate as low as they can. It's kind of like cutting the legs off a table. You know, you cut 1 inch off and then it doesn't balance, and you cut 1 inch off another leg and it doesn't balance. You keep doing that, and all of a sudden the table becomes a tea table with legs 6 inches long. That's very much the risk we're in as far as raising rates. The interesting thing about this, if you think about it, is that all the market consensuses can only be right sequentially, but not simultaneously. In other words, the stock market cannot keep going up like this when it's already overvalued, unless the economy picks up. And if the economy does pick up, then interest rates will rise. If interest rates rise, that means the bond market is priced incorrectly right now. So either the stock market or the bond market is priced incorrectly, and the other one's priced correctly. Because right now, the bond market is priced for low or stagnant economic growth for the next 10 years. So the stock and bond markets cannot, in the next 5 years, be both right. They can be right in the sense that the stock market crashes, goes down 40, 50%, and bonds then look wonderful, followed by a recovery, and then bonds start to go down. But you can't both be right. Now, the debt ceiling. In the next couple of months, the United States government is going to go into a kabuki theater of the debt ceiling. This is not a new thing. That's basically the ability to create a greater debt load for the United States. They blast through this thing routinely, but they do hold it up for political agendas occasionally. And even back in 1953, President Eisenhower was, on national security grounds, being it was a Cold War, was pitching the idea of a national freeway system, the interstate highway system, and he wanted to expand government debt. Previous to the use of the debt ceiling, they used to have to pass each bond measure in Congress separately. So the debt ceiling is actually a concept that allows the Treasury to just issue debt when it needs debt, and the government doesn't have to approve each bond measure. Anyway, that was during World Wars I and II, that debt ceiling was a big helpful thing for going deeply into debt. So it actually helped go into debt. In 1953, Eisenhower wanted to grow the highway system, and that was a gigantically positive thing for the United States. The infrastructure was magnificent, and it got held up by the Democrats, I might add, because whoever's in power tries to raise the debt ceiling, and the opposing party will, as in Kabuki theater, wail and shake and leap about, and doesn't matter if it's Democrat or Republican. They don't have any convictions about this. They just want to use it as a method of bending the government in power over a barrel. We had it in 1995, we had it in 1996, and then we had it in 2011. And that was serious because that resulted in the S&P, the Standard & Poor's rating company, downgrading United States debt. So the thing about this is that, yes, I expect political posturing and threatening and dire, they're going to ruin Social Security. Well, Social Security is in trouble already, but not for the reason of the debt ceiling. But I expect that this administration will threaten that everything's going to get shut down. All of us that get our giant subsidies, because we all do, we all get some benefit or another, that will be held up theatrically. They'll close national parks. You've seen that before. And during this time, markets do correct, but I have yet to see, at least in my memory, I have yet to see a stock market crash. It drops 10%, it drops, 15%. It doesn't spin into something big and serious, because inevitably the debt ceiling will be raised. I mean, how many days of agony do you want to experience? And if you remember, there have been times when the Democrats were in power and the Republicans, it was their turn to mess with the debt ceiling. So they yelled and screamed and leaped about, and they ended up being blamed for it. So I'm not sure they want to do that again. So let's see what happens. But if you see a correction, the debt ceiling, at least in my experience, all that drama hasn't resulted in a crash yet. Okay, this is fascinating. This is really fascinating. Okay, you've got Alexandria Ocasio-Cortez. She's wearing the dress right here that says "Tax the Rich" on it. And here, of course, you have all these people dressed like aliens. But anyway, this is the Met Gala, or Gala, however you pronounce that, Met Gala. New York Metropolitan Opera, and it's their fundraiser, and a ticket costs $35,000. I don't know about you, but I don't have $35,000 laying around. Anyway, Alexandria Ocasio-Cortez has run on the simpatico with los pobres. I am cool with the poor people, and I'm going to fight capitalism at every turn and socialism, and she shows up looking great. I mean, doesn't she look great? Look, she's a congressperson here. She looked great. And her very expensive gown says "Tax the Rich," which, of course, here's a young woman. I think she's about 30. She has a chance to join the political elites and go to a very expensive party, which is really cool, and look hot. Okay, that's a normal, I mean, I want to go to a big party and look hot. I mean, who wouldn't? The elites almost always, I mean, George Washington walked away from being king, so it doesn't happen all the time, but the elites pretty much always look out for themselves. So right now we're looking at all these tax law changes, and the stuff that they are proposing would destroy the American economy. I mean, it would blast us back to the Stone Age. And the inheritance tax that they're proposing is just vile. It would destroy small businesses, make large corporations absolutely take over completely, because it would tax small businesses, let's say 20 million and under, would tax them out of existence, and the heirs could not inherit it. So they'd sell to a large corporation, and you end up with Facebook, Costco, Walmart. Okay, that's an intentionally blurry picture because I don't want to be able to identify the singer. But basically, Yes, we need tax reform. We need simpler, we need cleaner. And yes, it's appropriate to tax billionaires appropriately, but this won't be it. I expect much theater, like that lady singing there. I expect misdirection. I expect bizarre compromises. I expect much angst and chaos in the media. On both sides, the right's going to scream that we're being destroyed. Actually, what happens if they did pass radical taxation is that it would be the end of the regime. They'd get blown away in the next congressional election. The mega rich are already being offered escape hatches. They're already being rewarded. We're talking about the billionaires out there. They are able to hire the lawyers, hire the CPAs. The accountants are already all in a line, whereas the normal rich, let's say the people that are worth 10 to 20 million, the people who own the small businesses can't afford that kind of push. So they're going to get nailed to the wall if this stuff actually gets passed. Whereas the billionaires will escape because there's already stuff being built in, like the, well, I could go on, but the bottom line is that the super rich will be protected because the elites always look after themselves. Now, here's the caveat. Let's say that for some strange reason, through some political consumption of LSD, they actually passed what they're talking about. That would trigger a genuine, real correction in the stock market. The reason it would do that is that if the capital gains rate does go to the ordinary income rate, nobody has any incentive to keep their stocks beyond December 31st, 2021. If you've got profits, you'd want to take them now. If you've got an estate, you'd want to distribute it now. So that would probably, who knows what would really happen, but right now, the irresponsible and inflammatory taxation talk like Ocasio-Cortez saying tax the rich as though the rich are evil, which they are not. We all look out for our own interests. We all do. And the rich are no different. That kind of stuff could result in a genuine stock market turn down of epic proportions. It could trigger something big that not even the Federal Reserve would be able to cope with. So that is a storm cloud, definite warning. Debt ceiling is a bit of a rainstorm. Potential taxes, a hurricane. However, I don't think it's going to go there. I think there's going to be some sort of compromise. And I think watch the Democrats waffle back. The Republicans do the same thing when they're in power. So it's not like the Democrats are unique in this, but watch the Democrats back it off so that after all the rhetoric to please their progressive base, they will get sane. But what we want, which is simple, effective, fewer deductions, much simpler to understand, that's not going to happen because unfortunately crony politics is fully in charge in Washington. Political turmoil. This is big. We're hearing all of this. We're going to do such a wonderful job, but there's something bigger than both political parties. And that is that the United States is in a malaise. And it's been in a malaise for a couple of decades, perhaps even the 1990s. It's been in a malaise and we are a bit mystified as to why. But if you look at it, the government is expecting a real negative interest rate on cash, which means you'll want to be in stocks and bonds, even if it corrects. You've got to build the courage to buy while it's down. They expect an almost stagnant economy after the COVID stimulus is over. By 2023, they expect it to be becoming like our normal stagnant growth. And in 2024, it's back to being stagnant again. And that's not going to wash with the vast numbers. I mean, you think about it, 50% of American households last year paid no income tax. That's not a good thing. It's not a good thing. It's from my perspective, it's not a good thing in that It means that 50% of the American population is not participating in the American dream. So something's busted. There is genuine wealth inequality. There is genuine income inequality. Solving that is not about taxes. It's much more structural than that. And we're not doing it. So what's the trust quotient I put in here at the bottom? After Afghanistan, after hearing today that 10 people, including 7 kids, got blown up by our government, and then we were told that it was a terrorist car that got blown up. This just keeps happening, doesn't it? Every day there's something else. What's the trust quotient for this prediction? That is, I predict low. Now here's that fundamental challenge. Jerome Powell, March of this year, I truly believe that we will emerge from this crisis stronger and better, as we have done so often before. But about here, in 1990, you can see that the rate of growth for the United States economy, that's rate of growth, stalls. And then you get this lower rate of growth until 2000, and then it stalls. And then you get to 2008 and the economy stalls again. And so what you've got is a lower and lower and more stagnant rate of economic growth. Is this demographics? Is this old people just getting tired? I don't think so. Something bigger is happening. And that's big when you think about what does that mean for the stock market? What does that mean for the bond market? It means the people that are meshed up in this stagnant economy get to pay all that debt back. How's that going to work? So I would say, and feel free to react. Let me know what you think. We have an American malaise. We are all allowing ourselves to be horrifically manipulated in some way into embracing disinformation, poor information, demotivation. We're being told that we can't, we're being told that we shouldn't, we're being told that and especially it's awful to watch this among young people where the suicide rates soar, education rates decline. And yet we think that we need to blame the other person. We're taught that, that it's their fault. It's their fault, whoever they are. So you've got, this is George Floyd riots in Los Angeles, burning the police department. And then you've got the January 6th Capitol riot down there, both of which came from profound misinformation. And yet we think we're right and whoever it is over there is wrong. The internet age, which starts about the same time as our economic malaise, is providing venues for us to injure ourselves as individuals and also as communities. An example of this happening financially are these serial stock market bubbles we've had, but cryptocurrencies are a classic example. Cryptocurrencies are, they're unexplainable. They don't do anything. Now, look over here to the right. You can see, according to addiction expert Dr. Anna Lemke, who really deals with opiate addictions and things like that. By the way, the opiate addiction rate rose just right along with that stagnant economy. Our smartphones are making us dopamine junkies with each swipe, like, and tweet, feeding our habit. Okay. What is investing? Just picture you're a young person. What does investing in cryptocurrencies do for you? And that is, it gives you that connection to that flowing pleasure stream. I'm doing something hip. Also meme stocks, also the most recent IPO. This has always happened before, but the internet's made it much, much easier to get that fix right now. Now, yesterday, Wall Street Journal came out with the fact that Instagram is toxic. It's genuinely damaging to mental health for teenage girls. The evidence just stacks up that the internet is like, it's like red wine, I think, in that one glass is good, 2 glasses is okay, 18 glasses, not so good. Same thing with the disinformation we are allowing ourselves to accept. We have become flaccid, if I could use that word, in our intellectual ability to interpret information. Basically, we are interpreting a shriek on the Facebook street corner as being just as valid as raw statistics from the National Institute of Health. And it's damaging us. Not participating in Facebook is not the only issue. I mean, I have friends and clients who don't get on social media, but they still watch news all day, and the news is skewed, horribly skewed. And so that's contributing to this American malaise, I think. It's also demographic. I mean, we're older and there's fewer kids. But it's an interesting study here. Over on the lower left, merely observing someone publicly blame an individual in an organization for a problem, even when the target is innocent, greatly increases the odds that the practice of blaming others will spread. In other words, people start blaming other people for their own problems. I've got a hangnail and you're responsible. And we stop thinking about how to build the best possible life. You know, I'm looking at a bunch of books here. I'm looking at The Rise of History. I'm looking at The Rise and Fall of the Third Reich. And the word decadent comes to mind because decadence is defined as something that is gratuitously pleasurable in the short run, but which harms yourself or society in the long run. By that standard, allowing ourselves to enjoy bullying, shrieking, absorbing information without doing the hard work to figure out if it's true, all that is kind of decadent. So what we've got is an outbreak of American decadence. And check this out. The results will probably be long-term, and here's one example among many, many. This is the interesting, strange statistic that men have decided to stop going to college. Men. Break it down by race. And actually, you could say that white European Americans are the first in line dropouts. They are choosing to not get into college, not to finish college. They are deciding to, and this, of course, there's technical classes, there's all kinds of schooling that goes on in the technical era. Classic college, you could say, has been made somewhat obsolete. But the fact remains that a lot of our young people are dropping out from despair. I was just reading it the other day, and the quotes from these young people are absolutely horrific. They have been talked into believing that there's no future because of global warming, because of their racial guilt, whatever. The fact is that all this information is having an extremely corrosive effect on our United States. And I have no idea how to interpret that as an investment advisor, except to say that they're probably going to underperform. I mean, they're probably going to underperform their parents. We, the baby boomers, are already underperforming our parents. We're not doing as well as they did as an average. Again, complex reasons, but what I am concerned about is this is the population cohort that we're leaving all this debt to. I suspect that it's going to increase the oligarchic tendencies in the United States inevitably, regardless of who's in power. Inflation. Right now, it looks like it's temporary. Inflation spiked. As you can see, this is the inflation spike of 2021. It's nothing compared to what we had in the 70s and 80s. For one thing, per capita, we used much less gasoline, and this was the 70s and 80s inflation was caused by fossil fuels, the embargoes, things like that. But also, that low interest rate is going to kick us into a recession quickly as soon as we start raising interest rates. So yes, recession is, inflation is back. It's an issue, but at this time, I'm not seeing it becoming permanent. For one thing, there is overproduction as one of the themes of the 21st century is that overproduction of basic commodities is pretty normal these days. And if any commodity gets expensive, somebody will up production. Now, COVID has disrupted that. I think the only reason we're seeing inflation at all is because of COVID. But basically, I'm not seeing it as a permanent issue. If it is, that'll change the game. That could force a stock market correction upon us. Right now, it doesn't seem to be happening. So, diversification, discipline, caution, and courage. What am I doing right now? Okay, cut to the chase. September 16th, 17th. Yes, it's the 17th. 2021. We are riding, we continue to ride, we continue to experience some marvelous financial market upturns. We have doubled since the low of March 2020. It's been astonishing in the stock market. Life is good. We are now facing some genuine potential short-term disruptors. Those are the debt ceiling, which I think it'll give us 10% down, something like that, but I don't see it evolving into a negative 50. The tax issues, which are going to be a big deal, potentially, if they actually happen. And I doubt they're actually going to happen. So we have to watch that. Another thing we have to watch is obviously COVID. COVID could change. Right now, it's going away. It's a storm cloud, but it's not right in our face. We have to watch out for this social unrest and political malaise going on. That's a long-term thing. That's going to really manifest over the next 20 years, but it's probably not going to manifest this year. And finally, inflation, which I think is not that big of an issue. But we do have some clouds. We didn't have some clouds 6 months ago, and now we do. Demographics, as I said, are suggesting long-term challenges, which we will probably overcome. And it has the potential to be pretty turbulent and chaotic. And remember, we can't blame anybody else, can we? The choices we make in our own life, in our own environment, are the choices that, when you add them all up, make up our communities and make up how the government and how the United States works, how the entire United States ends up functioning. And so we can choose how much of this chaos we want to let into our lives and how much we want to believe. And also we can guide our families while we do that. I want to keep our portfolios in relatively low risk allocations. I've already done that. I've gone through the whole pandemic. I did buy back in March, but that's the last time I ever went on a buying spree. Right now, I've just been riding it out, waiting for the other shoe to drop, but we're low risk, and this is why. I think that any downturns will be short term. They won't be permanent. Even a negative 50 will not be permanent because we'll have regime change. The people come up to me and they say, gosh, if they pass that new tax law, we're screwed. We should just, flush it all down the toilet. And I go, no, because as soon as they do that, then there'll be a pushback and the tax rates will change again. I think the Democrats are very aware of that. So I intend to buy on substantial weakness. If you see trades in your portfolio that include buying, that's why I'm doing it. So courage, and let's go forward. Okay, that concludes for September 17th, 2021. Couple of books. The Lessons of History. This is a book written in the 1960s, Will and Ariel Durant. I find it fascinating because it's written about 1970, say it was published, and it's after a study of 50 years, what does a historian think? And what he says is that human nature doesn't change. technology changes, behaviors change when we take trains instead of walking, but human nature doesn't change. Think about what that implies. I'm also reading The Proud Tower, which is about the start of World War I and how it caught everyone unaware. Because we may not face World War I, but we are facing a time of immense change and people don't know what to do. And finally, I am rereading The Rise and Fall of the Third Reich by William Shirer because of Chamberlain's sellout in Czechoslovakia and what that did for Europe going forward in 1938. Thank you very much. Please call me if you have any questions. Stay safe, stay wealthy. Let's go do this. Thank you.